Early retirement distributions and penalties under United States tax law. 1. Executive Overview. This report analyzes the additional 10% tax on early distributions from tax-deferred retirement accounts, the ordinary income taxation that accompanies such withdrawals, available statutory exceptions, and planning techniques to reduce or eliminate the additional tax for separations from service and early retirees. Footnote. This section frames the inquiry around penalty avoidance, tax efficiency, and prudent sequencing of withdrawals. 2. The 10% additional tax. Withdrawals from traditional individual retirement arrangements and employer-sponsored qualified plans before age 59.5 generally trigger an additional 10% tax. The additional tax applies in addition to ordinary income tax on the taxable portion of the distribution. A $50,000 early withdrawal can generate a $5,000 additional tax before considering income tax liability, thereby reducing net proceeds materially. Footnote. This section identifies the controlling age threshold and quantifies the baseline cost of early access. 3. Ordinary income taxation of distributions. Amounts withdrawn from pre-tax accounts are includable in gross income in the year received to the extent not previously taxed. The tax rate applied is the recipient's marginal ordinary income rate for that year. The additional 10% tax is computed separately and does not substitute for income tax. Footnote. This section distinguishes the penalty from ordinary income taxation to clarify cumulative liability. 4. Statutory exceptions to the additional tax. Limited exceptions permit penalty-free access while preserving ordinary income tax. Examples include first-time home purchase from an individual retirement arrangement up to $10,000, qualified higher education expenses from an individual retirement arrangement, birth or adoption up to $5,000, unreimbursed medical expenses exceeding 7.5% of adjusted gross income, and health insurance premiums during qualifying unemployment. Eligibility depends on account type and on satisfying documentary and timing requirements. Footnote. This section catalogs common exceptions and emphasizes that penalty-free does not mean tax-free. 5. Account type distinctions. Rules differ between individual retirement arrangements and qualified plans such as a workplace plan. Several exceptions apply to individual retirement arrangements but not to workplace plans. Plan terms and federal law governing workplace plans may constrain in-service access, whereas individual retirement arrangements generally follow statutory exceptions without plan-level gating. Footnote. This section explains that the availability of an exception turns on the legal character of the account. 6. Practical caps in use cases. Exception amounts are typically modest relative to large cash needs. The structure signals legislative intent to address discrete events such as down payments, education costs, and specific health-related expenses rather than broad income replacement before retirement age. Footnote. This section notes that statutory limits support targeted relief rather than wholesale early liquidation. 7. Liquidity planning outside retirement accounts. Maintaining an emergency fund, preserving access to a properly structured home equity line of credit, and disciplined credit management can reduce the need for penalized distributions. Retirement accounts are generally treated as last resort liquidity given tax friction and opportunity cost of foregone tax-deferred compounding. Footnote. This section elevates non-retirement liquidity tools as first-line buffers against unexpected expenses. 8. Separation from service at 55 rule. A participant who separates from service with the sponsoring employer in the calendar year of age 55 or later may draw from that employer's workplace plan without the additional 10% tax. Effectiveness depends on retaining sufficient assets in the workplace plan to fund income needs, while potentially rolling excess amounts to an individual retirement arrangement for broader investment options. At 59.5, the additional tax constraint ceases for both account types. Footnote. This section presents a strategy that pairs plan retained balances with later rollovers to optimize access and flexibility. 9. Substantially equal periodic payments under Section 72T. An individual may establish a series of substantially equal periodic payments based on approved calculation methods and life expectancy. Commencement before 59.5 can avoid the additional tax if payments continue for 5 years or until 59.5, whichever is longer. The regimen is strict, and modification or cessation outside permitted parameters can retroactively trigger the additional tax on all prior payments in the series. Footnote: this section identifies a complex but viable pathway for early retirees requiring level income streams. 10. Sequencing and multi-year effects. Withdrawal timing interacts with tax brackets, deductions, credits, and future required distributions. Decisions that appear beneficial in year 1 can produce adverse consequences in later years, including bracket creep, increased taxation of other income, and higher premiums linked to income. Scenario analysis over multiple years is necessary before executing early access strategies. Footnote: this section warns that the secondary and tertiary effects of withdrawals can dominate headline year 1 results. 11. Governance and advisory considerations. Given the one-time nature of most retirements, specialized guidance can reduce error risk in designing withdrawal plans, coordinating account types, and documenting exceptions. A fiduciary standard and integrated tax analysis help align actions with long-term objectives and minimize regret from preventable penalties and taxes. Footnote: this section underscores the value of process discipline and duty-aligned advice in navigating technical rules. 12. Conclusion. Early access to retirement accounts is costly when undertaken without exception planning or sequencing discipline. The law provides narrow penalty relief for specific needs and structured programs for separations and early retirees. Robust pre-withdrawal planning, accurate account classification, and multi-year tax modeling are the central safeguards against unnecessary erosion of retirement capital. Footnote: this section concludes that careful design can preserve income while lawfully minimizing additional tax exposure.